Hello, and thanks for checking out this week's fastest 4 minutes in finance. Well, good news from the March inflation report this week, as the consumer price index rose a mere 0.1% month over month and 5% year over year. That's the lowest reading in 2 years and was seen by markets as a reinforcing indication that our economic fortunes may not be as bad as they could be. The 5% jump was the slowest annual increase since May of 2021. This is all good news for the economy, but it remains to be seen how good. As you know, the Federal Reserve has been on a rate hiking tear for the past year, raising interest rates in 9 consecutive meetings. The moves are meant to slow demand, which should slow inflation. The inflation data would seem to indicate things are working. Neil Dutta, the head of economics at Renaissance Macro Research, wrote in reaction to the report, quote, "If I think about the potential scenarios, 1, soft landing, 2, recession, 3, continued overheating, and 4, stagflation, the odds of stagflation went down while the odds of a soft landing went up. Good news for stocks," unquote. Well, investors have been uncertain for the past 15 months which of those 4 outcomes we will reach. And that's what's driven the market volatility and the bear market of 2022. Let's take a look at what all those scenarios would mean. First, a soft landing is the goal of the Federal Reserve and would simply mean that we have an economic slowdown, but not enough to drive us into a recession. And that is still technically on the table. Second, a recession. As we've reported before, this is a significant decline in economic activity. It is officially declared by the National Bureau of Economic Research based on several pieces of economic data. We could have a mild recession, or we could have a severe one. From a market perspective, it is important to note, though, that stocks usually rebound long before the recession is over. Third, continued overheating. Now, that would mean that demand and consumer spending continue to drive inflation up despite the actions of the Fed. And that happened for the first half of last year. Of course, we can't continue to overheat forever, though. This would eventually be the opposite of a soft landing. Let's call it a crash and burn. And last, stagflation. Now, this is defined as inflation remaining high with high unemployment and low demand. Now, this looks very unlikely at this point. Unemployment actually fell to 3.5% in the latest jobs report. So what's all this mean for your personal economy? Well, not much, really, unless you lose your job or you lose some income. And obviously, some of those possible outcomes would make that more likely to happen. But if you continue to budget, avoid debt, and save and invest, all of the market volatility should be a small blip on the radar of your financial future. And don't let the market volatility drive you to get too conservative with your investments. Stocks should be long-term investments. No matter which economic outcome we reach, it will soon be a distant memory, and another economic expansion will take its place. The irony here is if you let inflation scare you out of the stock market, you are actually letting inflation hammer you twice. Stocks are one of only 2 asset classes that have historically outpaced inflation. So keeping your focus on the long term instead of being frightened by our short-term economic outcome will help you reach your goals. A written plan can help you do that. Thanks for watching.